Hey everyone, hope you're doing well. This is Drew Creekmur here, and I'm a wealth advisor with Creekmur Wealth, and I'm joined today by another wealth advisor here at Creekmur Wealth, Andrew. And Andrew's going to be talking with me about just a number of recent events in today's flash briefing. We're going to talk about some of the market volatility and just some things to keep in mind for those of you who are working on your financial plan or maybe entering a new stage of life, whether that be retirement or a new job or whatever that may be. We're going to kind of walk through some best practices when the markets get kind of wild. But before we hop into that, Andrew, how you doing today, man?
I'm doing well. How are you doing today, Drew?
I'm good. I'm good. You know, the sun's out. Weather here at 65 degrees, so I'm pretty pleased about that, to say the least. So we'll see if that holds. Well, hey, let's hop into it. You know, we have this chart here that's going to provide some context around the history of just market declines. And I think it's so easy to forget whenever the markets keep moving up and people are saying stuff like, man, stocks always go up. That yes, over the long term, that is true. Stocks generally do go up, but there are periods of time in the market where things go sideways or even they go down. And I think it's so easy to forget whenever the markets keep moving up and people are saying stuff like, man, stocks always go up. That yes, over the long term, that is true. Stocks generally do go up, but there are periods of time in the market where things go sideways or even they go down. And sometimes when that happens after a long period of a rising market, that can be kind of shocking. And so I love this chart. It's a history from 1951 through December of 2020 that kind of walks us through how often different types of declines happen. You know, it's pretty normal for us to see a 5% pullback in the market. That happens at least roughly 3 times a year, and usually it only lasts for about 43 days. So, you know, that's fairly common, right? I think people always think, though, the big one, a bear market, which is a 20% or more pullback in the market, that is really, really concerning. And generally, bear markets happen about once every 6 years, and you know they usually last for about 370 days. And so we've actually not experienced that since March of 2020, which was a little bit of a self-imposed bear market. And so what's interesting is since December of 2020, we actually had the S&P 500 actually pull back by about 10% during the month of January of 2022. And so, you know, we've had some more recent volatility since the market's kind of recovered since March of 2020. And so, Andrew, you know, I think it's really important to kind of have some perspective. So if you're talking to someone, one of your clients or someone just on the street, you know, what would you kind of provide them? What's an important piece of information or a stat just to remember to help people stay the course whenever markets do kind of go sideways?
Yeah, I think you made a very good point on we've had such a bull market over the past decade, with the exception of a few other times, but people don't really get to see that this volatility is normal. The 10% pullback we've seen, or almost 10%, that is very normal in terms of a person's investing life. So it's the market's going to go up, the market's going to go down. So I think the number one piece on this chart is, you know, that's normal, and that you got to have a plan to kind of help ride the wave. You don't want to see that and be panic selling, and then you also want to be in the right time frame for, you know, do I have too much risk or am I taking enough risk? Because you don't want to be going into the first year of retirement having to withdraw money on a 20% pull down, or even if a bear market's 370 days, you don't want to be taking a big chunk out of your nest egg to pay for health care or anything like that. It's starting out.
Right. And I think you just nailed that. It's really about stage of life, right? When it comes to investing and having some context and making sure that you have a plan. And that's a huge thing of what we do here. We're goal-based financial planners. But with that stage of life conversation, you know, I think we kind of define there are 3 stages in your investing and savings journey. And the first phase, you know, it's the accumulation phase, or the green phase, or the go-go phase, where your job is just to save as much as you can and invest for maximum growth. And most people are in that phase, but eventually you transition to what is maybe the caution or the yellow zone, where you're getting close to retirement, you're 5 to 10 years out, maybe a little bit closer, and you're maybe just a few years after retirement. And this zone, Andrew, you just talked about it, it is probably the most crucial zone that determines long-term success when it comes to using a portfolio to supplement your living expenses. And then we have the red zone, which is generally you're in the decumulation phase, you're pulling money out. You want to make sure that you're taking the right amount of risk in that place as well. And so, Andrew, with markets bouncing around, and that's not something that we've seen over the last few years, what would you tell someone who just recently transitioned into maybe that pre-retiree or more recent retiree phase? What are the couple of pieces that you would want them to keep in mind to make sure they stay the course and are in the best place for success?
Yeah, so I guess I do have a couple pieces, but it all comes back to the one thing, and it kind of revolves around a plan. And it doesn't matter if you have, a professional plan or you're sitting there running numbers yourself. No plan is not a plan for this because, like I said, you do not want to be withdrawing money when we're 20% down or more for 370 days or a year. Coming back to that plan, it could be a bucket strategy, where if you have expenses for the first couple years, that maybe that shouldn't be as heavily invested in the market, and you should be saving that principal, and that can all be, found out from your risk tolerance. Another big one that we see clients kind of underestimate is healthcare. So, if you do retire before 65, you're going to have to come out of pocket for how many every years before you get healthcare, and that's a huge expense that a lot of people just don't really plan for or don't really think of, but that is another big one, and that all comes back to having a plan set in stone and knowing what's going to happen, whether it's bucket strategies, risk tolerance, and what you're trying to accomplish.
I think it's, I just thought of a question. Actually, I had someone ask me the other day. Said, hey, I love the idea of the bucket strategy or making sure I have the right risk, but, bonds are really not a great place to be right now. I don't want to have a couple years worth of cash sitting on the sideline. Like, where do I put my money that needs to be low risk money that I need in the short term? What are your thoughts on that? What would you tell someone who's in a situation like that? Would you say, hey, it's a collection of bonds and maybe some dividend stocks, or what would your just general thoughts be there?
So, that's a question that a lot of people are having right now because, as you've noted, so there's an inverse relationship between bonds and interest rates. As we see interest rates go up, bond prices are going to fall, and vice versa. So, you can't really go to the bank and get anything off of money markets, or CDs are paying such low rate too. It's kind of a hard spot to be, so there are other products that limit the downside risk on those. It just kind of depends on, what you're looking for and how long you have. So for instance, I know the 1-year ag bond is down about 3% right now. So, with these interest rate hikes coming up, and I think there's 4 in this year. I think we're going to see one in 5 or 6 weeks. I foreseeably see these losing more in value. So for someone who's, has a target date fund of 2050 and they have 27 or 28 years left until retirement, that target date fund will have roughly 10% in bonds. If I was in that situation, I wouldn't want 10% of my money working against me in bonds at the moment. So there are other products to help find that return.
And I like that you brought up target date funds. We have some people who will listen to this that are maybe that pre-retiree phase who, they're saying, hey, I need to be lower risk. How do I do that? We would say it comes back to your goals. We have a number of solutions that we can help you with. Then a large base of people watching this are using target date funds in their retirement plans to help save for retirement. And so you said 2050, right? A target 2050 fund?
Yep, that's what
Yep, so that would be someone who's what, about 25, 30-ish years away from retirement. Is that fair?
Yeah.
Yeah, and I really think it's important for people who have their largest non-real estate financial asset in their retirement plan to really recognize that the risk tolerance that they may have in those target date funds may not be appropriate for the current environment. And Andrew, what is a target date fund? How do they determine the asset allocation in a target date fund? Is it one size fits all, or is it unique and customized to people's goals?
I kind of think about them, like almost like a hat that you buy out at, a store, and that says, oh, one size fits all, and you put it on your head, and it's like a bowl on top of your head. They're literally meant for the masses. So, every year you're getting closer to retirement, it gives you more bond exposure because you're supposed to get less risky as you get closer to that age of retirement. So yeah, they really are a one size fits all strategy. And sure, they do their job for people who they're not really paying attention. They don't want to, but they're kind of doing people a disservice with, the risk tolerance and the bond exposure, especially at the moment.
Yeah, yeah, and that's really key to recognize is that at the moment it's probably not the right tool to be utilizing. And so, I really like this chart. It kind of shows us over the last 20 years what's happened in the retirement savings space. Back in 2000, there was $5.6 billion worth of funds in defined contribution plan. So this is like a 401k, 403b, something your employer provides for you to save, and in IRAs. And that's since exploded to over $23.5 trillion. I mean, that is a lot of money. And a lot of people, about 25% of those dollars are in target date funds, which, like you said, it's a bull in your head. It's good when you're first starting out, you're building your balance. But once you get above that $25,000 amount, you really need to start having some customization. And this is something that myself and our founder, John Creekmur, we talked about a few weeks ago. And we'll include a link to that video. If you do have a retirement plan and you're thinking about just the market volatility and what's going on with bonds and trying to figure out how to best invest your retirement plan, I would encourage you to watch that video. And we talk through the pros and cons of where we're at, and we walk through some solutions that we have to help address that. And so I really think that is important. So Andrew, you wrote a good blog piece that we're going to include in this email, kind of talking about the things to make sure that you avoid doing whenever markets go sideways. I would encourage everyone to read that. It's a really, really good piece to help you stay on the right track. Andrew, with what we've talked about here today, do you have any final takeaways for us?
Going over my notes before this, it kind of comes back to, you got to have a plan no matter what. That's really the main theme of, everything that tells me is, yeah, there's a bunch of different variables, but the plan will make everything come together. And without it, you're kind of, shooting in the dark and hoping for the best when it may not work out that way.
Right. And I think it's, like you said, having that plan and then having a trusted advisor, someone that can come alongside you who really is unbiased and able to provide you the data that you can then use to make the right decisions, ensures that you're not shooting in the dark and you actually are setting yourself up for success. And so I would encourage anyone, if you listen to this, you have any questions, give us a call. Andrew, myself, or another member of our team will help walk through any questions that you have. We offer a free 15-minute initial consultation. We'd love to chat with you. But until then, we look forward to talking with you, and we hope you all have a good day.